Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Cellebrite DI Ltd, CLBT.
A really fascinating company.
It is. It sits right at this really complex intersection of public safety, cutting-edge software, and incredibly high-stakes digital evidence.
And our mission for you today is pretty clear. We're going to synthesize the entire investment thesis for this mission-critical software leader. We need to cut through all the noise, all the complexity of the tech.
And the market volatility for
Exactly, to get to the core value proposition. So here's the thesis.
Let's hear it.
Cellebrite is a resilient vertical market software leader. It's betting that its accelerating shift to cloud and AI, plus the big $170 million Corellium acquisition, will drive ARR growth acceleration in 2026.
And that acceleration is key because it's meant to offset some pretty serious near-term U.S. federal headwinds and, the valuation compression we're seeing in 2025.
That's the central conflict right there.
That thesis really frames it perfectly. Short-term pain for what they hope is long-term strategic gain. So let's unpack this, and let's start with the fundamentals.
Always the best place to start.
When you look at Cellebrite, you're not looking at one of those grow-at-all-costs Silicon Valley stories. This is a company that has consistently proven it can balance really strong double-digit growth with, frankly, enviable profitability. So what is the latest financial snapshot? I'm thinking Q3 2025. What does that tell us about the core health of the business?
The Q3 results really painted a picture of durable, profitable growth. It's exactly what you want to see in a quality software company, especially since they're navigating some pretty specific turbulence in their sector.
So what's the headline number?
The headline revenue number was very robust. It came in at $126.03 million.
And the growth on that?
That's a solid 17.9% growth year over year. But here's the really crucial detail, the part that gives investors confidence. It's the quality of that revenue.
Right. It's not all created equal.
Not at all. Approximately 89% of their total revenue is now tied to subscription-based software solutions.
89%? That's a huge number.
It's fantastic. It gives you incredible visibility, predictability, and, ultimately defensibility. It means they're not just relying on these lumpy one-off hardware sales anymore. They are selling repeatable access to mission-critical tools.
High-quality revenue is obviously paramount, but for a company that's so SaaS-focused, the real test of momentum is always annual recurring revenue. ARR. It's the lifeblood. So how strong is that pulse, especially when you think about who their customers are? Global law enforcement, intelligence agencies.
The ARR pulse is very, very strong. It continues to show really robust momentum. So annual recurring revenue hit $440 million, which is a 19% increase year over year. But what I find even more compelling and what really speaks to the sustained demand is the sequential momentum.
From Q2 to Q3.
Exactly. That $440 million was a healthy 5% sequential jump from the second quarter. That shows you they're consistently expanding their footprint, capturing more wallet share, even as they're growing against a much, much larger baseline.
And I guess you have to remember, their products aren't. They're not discretionary.
Not at all. They are essential tools. You need them to process digital evidence, which makes that demand incredibly inelastic.
And that necessity, that should translate directly into customer loyalty, which we can actually measure with retention rates. So for you listening, maybe prepping for a meeting on this, this is where you can quantify Cellebrite's dominance. How locked in are these customers, police departments, federal agencies, once they're on the platform?
They are incredibly sticky. This is really where the whole vertical market software model just shines, and you can see it in two stellar metrics. First, gross retention is sitting at about 91 to 92%.
So just to be clear, that means more than 9/10 of their existing revenue just stays put year after year.
Precisely. Losing less than 10% of your revenue in a year from churn is exceptional. It just reflects how deeply integrated they are. The switching costs to move your entire forensic infrastructure, it's just massive.
But the real story isn't just keeping the customers you have, it's getting them to spend more. And that brings us to that second and maybe even more impressive metric, the dollar-based net retention rate, DBNRR.
Right. And that sits in a very robust range of 120, 121%.
Okay, let's slow down here. For anyone hearing this metric for the first time, what does a DBNRR over 120% actually mean for the investment thesis? What is it telling us?
It is the physical manifestation of the classic land and expand model working perfectly.
But inside government agencies, which are famously slow to spend, How are they pulling that off?
Well, a DBNR of 120% means that the average existing customer spent 20 to 21% more money this year than they did last year.
Wow.
Yeah. So they aren't just adding new customers to Treadwater. They are systematically deepening their relationships with these embedded clients.
So what's the strategy there? How they do it?
It's a very deliberate cross-sell. So they typically land an agency with their core tool, Insights. That's the hardware and software you need to pull data off a seized phone.
The entry point.
Exactly, the entry point. But once that device is in the forensic lab, that's when they expand the wallet share. They start cross-selling these high-margin advanced solutions like their AI analytics platform, Pathfinder, and crucially, the cloud-based evidence management solution, Guardian.
So they're turning a one-time license or hardware sale into a full-blown subscription relationship.
That's the entire game. And that high DBNRR is probably the single most important metric that cements their long-term growth story and their competitive moat.
That strong expansion rate, the high quality of the revenue, it must naturally flow down to profitability.
Yeah.
If the top line is subscription-driven and the customers are that sticky, you'd expect to see some serious margin expansion. Are they pulling that lever effectively?
Absolutely. And this is really where Cellebrite stands apart from so many of its high-growth but, often unprofitable software peers. They have immense financial leverage. Okay. I saw that in Q3. Impressive margin expansion, with Adjusted EBITDA reaching $37.7 million.
And what does that translate to as a margin?
That equates to a very, very healthy 29.9% margin, and that's up 60 basis points year over year. To achieve nearly a 30% profitability margin while you're growing ARR at 19%, it just underscores their capital efficiency and, frankly, their pricing power.
And that's EBITDA. But crucially, how does that efficiency translate into, actual cash, the real money?
Well, their business model is inherently capital light. They don't need massive ongoing investments in, physical assets or huge data centers to keep their growth engine running.
Yeah.
And you see that reflected powerfully in their trailing 12 months free cash flow, which stood at a phenomenal $140 million.
And the margin on that?
The cash flow resulted in a robust 31% margin. And, whenever you see your free cash flow margin exceeding your EBITDA margin, that's a very clear signal that the company is just incredibly effective at converting its earnings into spendable cash.
So if we combine those two critical metrics, that 19% ARR growth and the almost 30% EBITDA margin, there's that famous industry benchmark, right? The rule of 40. Does Cellebrite clear that hurdle?
They don't just clear it, they blow past it. They belong to a much more elite category that management actively targets. We're talking about the rule of 45.
A rule of 45.
Right, so you take the 19% ARR growth, you add the 29.9% EBITDA margin, and you get a combined score of about 48.9.
So well within that elite category.
It firmly places CLBT as a rule of 45 company, and it's right within management's committed long-term range of 45 to 50. This metric is just a powerful quantitative statement that says even with all the global headwinds and geopolitical complexity they operate in, they're executing flawlessly on their financial model.
Okay, and just one last point before we pivot to strategy. The Corellium deal was a big cash outlay. Do they have the dry powder to make these big strategic moves without taking on a bunch of debt or straining the business?
They have a fortress balance sheet, a lot of firepower, as they say. As of Q3, the company had a strong cash position of $595 million.
Wow.
And that cash balance is critical. It gives them the flexibility for more R&D, for future M&A like Corellium, and they can do it all without relying on debt, which is basically negligible on their balance sheet. That position really de-risks their ambitious plans for 2026.
Okay, so that financial resilience is clear. Let's talk about where it comes from, the technology, because here is where it gets really interesting. That rule of 45 status, it's basically funded by a huge technological shift that's addressing this dire escalating need in law enforcement all over the world. We really need to detail why AI is no longer optional for their customers. It's a necessity.
It is. The core problem that Cellebrite solves is this absolute overload of digital evidence that investigators are facing. It's not just a big problem, it's a systemic crisis of bandwidth. Modern crime is digital crime.
Right.
Digital evidence is now involved in an estimated 90% of all criminal cases.
90%. I mean, that's basically everything.
It's everything. And when you couple that with the sheer volume of data being generated, which has grown by over 76% in just the last 3 years, investigative teams are they're drowning in terabytes of unstructured data.
I remember that story about the the Oakland County mass shooting, where tools like their AI platform were crucial in analyzing the suspect's devices almost immediately. But what's the day-to-day impact of this data tsunami on just an average police department?
The day-to-day impact is a massive bottleneck. It leads directly to delayed investigations and ultimately delayed justice. Right now, investigators are facing an average backlog of 3 to 4 weeks just for the digital forensic examinations.
3 to 4 weeks, just to get started.
Just to get started. Think about that. Evidence that could solve a major crime or, exonerate someone, it's just sitting on a shelf for nearly a month because the labs are overwhelmed. And it gets worse. Our sources show that 68% of investigative teams don't have the time to review all the data they collect.
So they're just guessing what's important.
They're forced to triage. They prioritize the most obvious leads and potentially crucial context gets discarded. And on top of that, an astonishing 60% are still using these outdated, non-auditable methods like physical USB sticks to share forensic data internally.
Oh, wow. That's a huge security risk.
It compromises security, chain of custody, everything.
So if the data volume is growing exponentially and human capacity is just completely maxed out, AI isn't some futuristic toy. It's the only way to clear that bottleneck.
Precisely. AI and machine learning, they provide the only scalable, auditable solution to this problem. For an investigator, AI is a force multiplier. It helps reduce manual review time by up to 85%.
85%?
Yeah. It automates tasks that were just impossible before at this scale, like image and text analysis. It lets investigators quickly find names, locations, phrases across thousands of different devices and cloud accounts. It just transforms this daunting, multi-week task into a streamlined process.
So let's talk about Cellebrite Solutions. That 89% subscription number we talked about confirms the trend. But how much of their business is now fully clouded or SaaS-based? The most efficient model.
The transition is accelerating very quickly, and it's a cornerstone of that whole 2026 growth story. Their cloud and SaaS solutions are gaining traction fast, and they've now reached 20% of total ARR.
And the growth rate on that 20% must be huge.
It's soaring. It really reflects where management is focusing their energy.
And within that growing cloud portfolio, is there a standout product, something that's really driving that acceleration?
Oh, absolutely. That would be Guardian Cloud SaaS.
Guardian, what does that do?
It's their evidence management and chain of custody solution. For law enforcement, maintaining a perfect chain of custody for digital evidence it's a non-negotiable legal requirement. You need it to get the evidence submitted in court. Guardian manages that entire process securely in the cloud.
And the adoption rate.
This product has delivered 100% plus ARR growth for 5 straight quarters.
100% for 5 quarters.
Yeah, just exponential adoption as agencies finally realize they just can't manage this complexity with spreadsheets and USB sticks anymore.
So how does Guardian fit into that land and expand DBNRR strategy you mentioned earlier? Is it part of that?
It is absolutely central to the cross-sell. Think of it like this. INSEADS gets them the data from the phone. Guardian organizes it, stores it, and makes that data legally defensible in court.
I see.
And the penetration of Guardian across their whole customer base is still relatively low, which means there's just this enormous runway for growth just by pulling this one lever. Management has said that deals involving 2 or more flagship solutions, like pairing INSEADS with Guardian, can be up to 10x the size of a standalone INSEADS deal.
10 times the size. That's the synergy that drives that 120% DBNRR.
That's the key right there.
Okay, so beyond new cloud products, they're also migrating their main product, INSEADS. And this isn't just a technical upgrade, right? It's tied to a monetization event.
It is. The flagship INSEADS migration moving customers from the old licensing model to the modern subscription-based one is moving ahead of plan. They've already achieved a conversion rate of 47% of the license base.
And what's the financial payoff for that conversion?
This is why it's so strategic. The shift to the modern model yields a significant 20-25% pricing uplift compared to the legacy pricing. So they're modernizing their core tech, accelerating cloud readiness, and realizing substantial new revenue from the customers who already rely on them. It's just a very efficient way to grow.
That's the present momentum. What about the immediate future? What's the next big AI catalyst they're working on that takes them, beyond the forensic lab and deeper into the detective's actual workflow?
The next big step is the launch of Guardian Investigate. It's a SaaS AI solution, and it's expected in early Q1 2026. This is the logical extension of their whole platform. It moves them further into the actual detective and investigator workflow itself.
So how is that different from what they have now? Instead of just analyzing a single phone, What does Guardian Investigate let an investigator do?
It lets them synthesize huge amounts of disparate information all at once. So that means integrating data not just from the phone extraction, but also from call detail records, from open source intelligence, digital documents, case files, everything.
All in one place.
All in one place. The goal is to apply AI contextually across all those data points at the same time, letting investigators build stronger case narratives collaboratively and securely in the cloud. This move into the investigation workflow is a major high-value expansion of their total market.
The company clearly sees AI and cloud as the future. And that leads us right into their biggest strategic move of the year, the $170 million Corellium acquisition.
A massive bet.
It is, both financially and strategically.
It is a huge bet, and it's aimed at expanding their tech lead, diversifying their market, and getting into these new high-value sectors. I'm thinking specifically defense and intelligence.
Okay, so let's break down the details. What exactly did Cellebrite buy for $170 million?
So the deal is valued at $170 million in cash. There's an initial $20 million converted to equity and a potential for another $30 million in performance earnouts. It's expected to close in Q4.
And what does it contribute financially right out of the gate?
Financially, Corellium brings in about $15 million in existing ARR as of June 2025, which tells you right away that the valuation isn't about current revenue multiples. It's all about the strategic tech moat that they're acquiring.
Right, that ARR is a drop in the bucket compared to the purchase price.
Right.
So the enthusiasm has to be about the future cross-sell.
Yeah.
Did the market validate that idea right away?
Immediately. The enthusiasm for the synergy was palpable. The company reported that they had already built an 8-figure pipeline, so tens of millions of dollars, before the deal was even finalized.
Wow.
Yeah, that just validates the strategic fit and confirms there's urgent demand for the combined technology.
Let's talk about Corellium's actual technology. They're leaders in ARM-based virtualization. For those of us who aren't, deep in the tech, why is that specific technology so important for what Cellebrite does?
So, in simple terms, Corellium's tech lets security professionals create perfect virtualized versions of operating systems like iOS or Android that run on, non-physical hardware in a computer.
And why is that a game changer?
Because it lets them safely test exploits, research vulnerabilities, and develop new ways to extract data without needing the physical phone and without risking damage to the evidence device.
I see. So it lets them stay ahead in that constant cat and mouse game with Apple and Google, who are always making security tougher.
Exactly. This virtualization capability is a technological superpower. It significantly boosts Cellebrite's ability to keep pace with, and in some cases, get ahead of the phone manufacturers. This is the key to unlocking the highest echelons of government spending, especially in defense and intelligence, which is seeing rising spend globally.
That sounds like tech. That's mostly for the R&D lab, though. But they have this new product planned, Mirror, which sounds like it brings this tech right into the courtroom. Tell us about Mirror.
Mirror is the big product synergy they're developing. It uses Corellium's tech to create these dynamic, interactive, virtual versions of seized devices and all their data. Think of it like a digital twin of the evidence device, accessible securely in the cloud.
Okay, but what's the tangible payoff for a prosecutor standing in front of a jury? Why is a virtual version better than a detailed report or a stack of screenshots?
The so what's is all about legal defensibility and narrative power. It helps prosecutors present more compelling visual evidence. Instead of showing static screenshots or these dense technical reports that might just confuse a jury, they can visually walk the jury through the device's content.
I see. So they can show how the user interacted with an app or reconstruct a conversation.
Precisely. It shifts how digital evidence is presented, moving beyond jargon to a persuasive, memorable narrative, and that dramatically increases confidence in the evidence.
So the Corellium deal, the AI push, they're clearly setting the technical foundation. But the biggest lever for the company in the short term seems to be the reversal of this temporary challenge. The U.S. federal headwinds. What does this resurgence look like for 2026?
The U.S. federal government is a huge part of their business, about 17% of their 2024 revenue, and throughout 2025, that whole segment faced serious headwinds.
And these weren't competitive losses, right?
No, not at all. These were logistical and political hurdles. Funding delays, budget uncertainty in D.C., constrained spending visibility. The demand was still there, but the procurement budgets were basically frozen.
And management was pretty clear about what that slowdown cost them this year.
They quantified it precisely. The slowdown translated to a loss of 4 percentage points of total ARR growth for 2025. But they've stressed that these delays are purely transitory, which you can see in the fact that federal execution actually bounced back strongly in Q3. The underlying demand is still very much there.
I get that the demand is there, but federal agencies can't just flip a switch and start spending again. What's the specific, regulatory unlock that turns this headwind into a tailwind in 2026?
That would be achieving FedRAMP High Authorization to Operate status, or ATO. FedRAMP isn't just a certification, it is the critical, rigorous compliance unlock you need for any cloud solution to be adopted across the U.S. federal government.
And the high impact level is the gold standard.
It is. And what makes this process so difficult, but also gives Cellebrite an advantage, is who is helping them.
Who's that?
The U.S. Department of Justice, DOJ, is sponsoring their compliance journey.
Having the DOJ as a sponsor has to be a massive advantage.
It's a critical strategic nuance. It validates the urgency of their cloud solutions at the highest level of government, and this authorization is expected in early 2026.
So once they have that ATO, what does it unlock for them?
It unlocks the large-scale deployment of their modern cloud assets. Guardian Investigate, the latest insights across basically all U.S. federal agencies. Before this, their cloud stuff was essentially locked out of this 17% slice of their market. Analysts have estimated this could open up a sales opportunity of roughly $50 million in ARR potential.
50 million.
Yeah.
That's a huge number. So this isn't just a formality, it's a material event.
Highly material. It could shift the trajectory of the entire business segment.
And beyond that regulatory piece, there's also a very specific, very large contract renewal that's been delayed.
That's the third critical catalyst for 2026. A pending major contract renewal in the U.S. federal sector, held up by those 2025 budget issues, is still expected to close in the first half of 2026.
And it's not just a simple renewal.
No. This contract is expected to renew at roughly 2x in size.
Doubling a major federal contract. That's a massive shot in the arm. Why are they so confident in a 2x renewal?
It's because of the shift in the technology mix. The last time this contract was renewed, the agencies were mostly buying extraction licenses. Now they're shifting to the modern, higher-value, subscription-based cloud solutions, Guardian AI Analytics, which just carry a higher price point. When a renewal of that scale hits, it provides a very visible boost to the ARR growth rate.
Okay, so let's synthesize this 2026 outlook. We've got the Corellium expansion, we have the FedRAMP authorization opening the cloud floodgates, and we have a major contract renewal doubling in size. Management is arguing these will create a massive tailwind. Do you buy that they can execute all three at once and really drive that acceleration?
I buy the potential for acceleration. The underlying premise is sound. Management is highly confident these factors will converge and drive that acceleration in 2026, even though they'll be growing against a larger ARR baseline.
But the execution risk has to be high.
It's very high. Integrating Corellium, ensuring a timely FedRAMP ATO. These are major projects that have to be executed perfectly. And, the political winds in D.C. are unpredictable, so the timing of that FedRAMP unlock and the contract renewal are definitely the biggest variables.
That sets up our final critical section perfectly. We've laid out the entire bullish case. A 2026 acceleration driven by Corellium, AI, FedRAMP. Now we have to ask the final question. Does that long-term story justify the current premium valuation, especially when you weigh it against the very material risks that come with operating where they do?
That is the essential tension at the heart of this. First, we have to acknowledge Cellebrite is a very high-quality business, but the stock often trades at a significant premium valuation compared to its peers. Its forward EBITDA multiples are typically higher.
And that premium isn't arbitrary. It's because the market sees that competitive moat as nearly unbreachable. What is that fundamental moat, really?
It's formidable, and it's multifaceted. First, you have immense operational switching costs. Agencies need clearances, specialized tech stacks, extensive training. Changing vendors means throwing out years of institutional knowledge.
And then there's the legal side.
And this is the most important part. Its status as the industry standard. The output of its software is so trusted that in courtrooms, they often just refer to the Cellebrite report. That deep institutional acceptance, reinforced by that stellar DBNRR of 121%, that's what cements their dominance. It's incredibly hard for a competitor to unseat that trust.
But despite that deep moat, their work exposes them to significant reputational and legal risks. Let's address the elephant in the room, the political and regulatory headwinds, the misuse allegations.
These are material headline risks that every investor has to monitor. They operate in an ethically sensitive space, Their tech can bypass modern encryption, and that capability can be misused. We saw that with the allegations that their tools were misused in places like Serbia to target activists and journalists.
And their response?
Their response was swift. They investigated and said they stopped the use of our products by the relevant customers at this time, but the reputational damage and the constant scrutiny from human rights groups, that persists. It forces them to walk this complex geopolitical tightrope.
And they also face legal scrutiny closer to home, right? About warrantless searches.
Correct. You have to look at the APIC lawsuit. The Electronic Privacy Information Center settled a lawsuit with ICE over the agency's use of Cellebrite tech for warrantless mobile device searches.
And even though Cellebrite wasn't the defendant, it put their tech under the microscope.
Exactly. It highlights the continuous regulatory scrutiny on their capabilities. It just adds complexity and cost to their business model.
And maybe the most acute technical risk, the one that could damage their core credibility, was that vulnerability highlighted by Signal's founder.
That was a very serious issue, raising questions about the integrity of the evidence itself. Signal showed that a specially formatted file on a device could be designed to execute arbitrary code on the Cellebrite machine during the scan.
Which is terrifying.
Right.
What's the practical implication of that?
It's profound. A malicious actor could theoretically compromise the Cellebrite software itself, potentially modifying past or future forensic reports. It calls the entire chain of custody into question.
Something that would be devastating in a courtroom.
Devastating. And while Cellebrite issued a workaround pretty quickly, it just underscores this ongoing high-stakes security race they're in. Their moat depends entirely on their R&D staying one step ahead.
Finally, let's talk about a mechanical risk to the stock itself. The ownership overhang from Sun Corp. For you, the listener, this is about supply and demand for the stock, not the business itself.
Right. The ownership overhang is a critical mechanical risk. Sun Corp, which originally bought Cellebrite, retained a massive stake after it went public. It was around 48% at the end of last year.
And they're selling it down.
They are. And while the sell-down is organized and rational, the fact that a large institutional block still representing roughly 40% of the company is gradually selling means there is persistent, heavy supply of shares hitting the market. That can dampen price appreciation and increase volatility, even when the fundamentals, the rule of 55, the 120% DBNRR, are exceptionally strong.
So to synthesize, we have a company with an undeniable moat, deeply entrenched, trading at a premium. It's pointed toward what looks like a resurgence in 2026, thanks to Corellium and FedRAMP. But that bright future has to be constantly weighed against the burden of being a technological superpower. The security race, the scrutiny over misuse, and the structural overhang on the stock.
It captures the complexity perfectly. The underlying fundamentals, high growth, leading margins, sticky customers, and that huge cash position remain exceptionally compelling. The bullish future, though, is heavily dependent on the successful, timely execution of those big strategic projects. The foundation is rock solid, but the path ahead requires flawless execution while navigating headwinds that few other companies ever have to face.
What an insightful deep dive. Thank you for walking us through the material and really defining the contours of both the opportunity and the inherent risk here.
My pleasure.
Risk defined, portfolio protected.